Term 116, MTI mortgage to income. The mortgage-to-income (MTI) ratio is a metric used by lenders to assess a borrower's ability to afford their monthly mortgage payment. It compares your gross monthly income, pre-tax, to your estimated monthly mortgage payment. Formula: MTI ratio equals monthly mortgage payment, principal, interest, taxes, and insurance, gross monthly income. A lower MTI ratio indicates a larger portion of your income goes towards your housing expense, while a higher ratio suggests a more manageable burden. Common MTI ratio benchmarks. Most lenders prefer an MTI ratio of 25% or below. Some lenders may allow a higher MTI ratio, up to 35% or even 40%, depending on your credit score, down payment amount, and other financial qualifications. However, these scenarios are generally considered riskier for the borrower. Overall, the MTI ratio is a crucial factor considered during the mortgage approval process. It provides a starting point for lenders to assess your affordability for a mortgage. However, it's important to consider your overall financial situation and consult with a lender to determine a mortgage payment that fits comfortably within your budget. Term 117, PMI private mortgage insurance. Private mortgage insurance (PMI) is an insurance policy that protects the lender, not the borrower, if you default on your conventional mortgage. It's typically required when you make a down payment of less than 20% of the home's purchase price. Term 119, escrow account. An escrow account is a neutral third-party account held by a closing agent, lender, or other trusted entity. It acts as a temporary holding place for funds related to a transaction, typically in real estate but also potentially used in other contexts. An escrow account plays a vital role in securing a real estate transaction by holding funds safely and ensuring their proper distribution at closing. Term 122, impound account or escrow account. Impound account, also interchangeably called an escrow account, is a neutral third-party account used in real estate transactions. It's essentially a holding place for funds related to the property, typically managed by a closing agent, lender, or title company. In essence, an impound account plays a vital role in safeguarding a real estate transaction by holding funds securely and ensuring their proper distribution at closing. The terms escrow account and impound account are generally used interchangeably. Term 125, corporate bonds. Corporate bonds issued by corporations to raise capital. The creditworthiness of the issuing corporation determines the risk and interest rate associated with the bond. Higher-rated bonds from corporations with a strong financial track record typically offer lower interest rates, while lower-rated or junk bonds may offer higher potential returns but come with greater risk of default, issuer failing to repay. Term 126, bond. In the world of finance, a bond is a type of investment that represents a loan you make to an entity, typically a government or corporation. When you buy a bond, you're essentially agreeing to lend money to the issuer, the borrower, for a set period, in exchange for regular interest payments and the return of your principal amount at the bond's maturity date. Types of bonds: government bonds, corporate bonds, municipal bonds. Term 127, municipal bonds. Municipal bond issued by municipalities to finance local projects. Interest earned on municipal bonds may be exempt from federal taxes and potentially state and local taxes depending on the issuing municipality and your residency. Term 128, note or promissory note. A note, short for promissory note, is a legal document that outlines the terms of a loan, including the principal amount, interest rate, repayment schedule, and borrower's obligations. Term 129, Certificate of Deposit, CD. A certificate of deposit, CD, is a type of savings account offered by banks and credit unions. It allows you to deposit a fixed sum of money for a predetermined period, typically ranging from a few months to several years. In exchange for committing your money for the term, you generally earn a higher interest rate compared to a traditional savings account. Term 131, General Lien. A general lien grants a creditor the right to seize and sell some or all of a debtor's property to satisfy an outstanding debt. It differs from a specific lien in a few key ways. 1. Scope of coverage. A general lien applies to a broader range of the debtor's property. It can encompass various assets the debtor owns, whereas a specific lien attaches only to specific property associated with the debt, e.g., a mechanic's lien on a car they repaired. 2. Type of debt. General liens are typically used for unsecured debts, meaning the debt is not tied to a specific piece of collateral. Common examples include unpaid rent, medical bills, or credit card debt. 3. Real estate limitations. It's important to note that general liens typically don't apply to real estate in most jurisdictions. For real estate, specific liens, e.g., mortgage, are more common.